Okay, let's unpack this. Welcome back to Beyond the Comfort Zone. We are here to take some of the deepest, most rigorous financial analysis out there and really translate it into clear, high-impact knowledge for you.
And our mission today is a really essential one. We're doing a deep dive into the latest market intelligence we're going to be dissecting, and it's a long one.
It is a mouthful, yeah.
The reserve of KING-KAMBUF Financial News and Reports Magazine, Weekly Market Digest and Investment Analysis, Comprehensive Market Analysis and Investment Digest for December 7th, 2025. Specifically, we're looking at the KING-KAMBUF Reserve Weekend Wrap and Outlook Edition Week Ahead Report.
Phew, yeah, let's maybe just call it the KING-KAMBUF Reserve Weekly Digest from here on out. It's a bit easier.
That's good.
But the report itself, I mean, it's absolutely professional grade. It gives you this crucial playbook for the really high-stakes period we're heading into now.
It does. And the central theme that it keeps coming back to is this massive paradox that's shaping the market.
Right. The whole thing feels simultaneously confident, but also incredibly fragile. You have indices near all-time highs, yet all these structural warnings are just, they're getting louder.
That paradox is exactly what we have to navigate. I mean, this market tension, it's being driven by three really overwhelming forces that are directing, all the capital flows as we head into the end of 2025.
Okay, so let's break them down. First, the one you just can't escape. The overwhelming anticipation of a Federal Reserve rate cut.
Right.
This isn't just a hope anymore, is it? It feels like the market has fully priced this in.
Oh, completely. The market is basically betting the house on policy relief, on a dovish turn from the Fed. That's number one.
Okay.
Number two, we have the ongoing just massive strength, but also this rising concern around technology and AI valuations.
The big question.
It is. I mean, these stocks have been pretty much the sole engine of the S&P 500's incredible run this year. But the question is, how much steam is left in that engine? And is it? Is it starting to overheat?
Which sets up the third force perfectly, and this feels like the most immediate risk. We have a truly pivotal week for earnings coming up.
Yeah, this is the moment of truth.
We're seeing major AI-related software companies, semiconductor names, all reporting.
And if those key names, you're talking Oracle, Adobe, Broadcom, if they deliver knockout results and, this is the important part, spectacular forward guidance.
Right. The guidance is everything.
It's everything.
Yeah.
If they do that, they could absolutely propel a Santa Claus rally. But if they disappoint, then we have to take all those serious overvaluation warnings that are highlighted in the report. We have to take them very, very seriously.
And that includes that number that just jumps off the page, the Shiller-KP ratio at a staggering 40.01.
40.01. That's the figure that justifies all the talk you're hearing about a potential 10% correction over the next few months.
So we're going to find out why the market feels so strongly pulled between what feels like historical risk on one side and this incredible technological optimism on the other. This analysis really demands a disciplined, deep look at the foundation and the technical structure.
It really does.
So let's start with part one, the current market climate. Let's get a snapshot and look at the volatility.
Okay.
The report describes the market's current psychological state as cautiously optimistic, but flat in pre-market activity as of December 7th.
Right.
We've seen back-to-back winning weeks for the indices, which you'd think suggests momentum, but the overall tone implies a real lack of conviction at these levels.
That cautious tone is absolutely key. When you look at the immediate numbers from the pre-market, S&P 500 futures were nearly unchanged.
Flat.
Dow futures were down, just slightly, maybe 0.1%.
Yeah.
Nasdaq 100 futures, same story, very little movement. This flatlining, it isn't exhaustion from running a marathon.
No.
It's exhaustion from waiting. Investors are just stuck in a holding pattern. They are explicitly delaying any major directional bets until they get some certainty around what the Fed's next move is actually going to be.
And the week that just closed, it did deliver some modest gains. The S&P 500 was up about 0.3%.
Modest is the word.
Yeah, but the report notes, and I think correctly, that the momentum just showed signs of fatigue. We are right there on the cusp of an all-time high. I think the report said about 0.7% away from breaking that record.
Mm-hmm.
Doesn't that remaining 0.7% gap, isn't that a massive psychological resistance zone?
Oh, absolutely. That 0.7% gap represents the market just trying to digest the sheer magnitude of the run we've had in 2025. I mean, to cross an all-time high, you don't just need buyers.
No.
You need a fundamental reason for people who are sitting on some pretty substantial profits to pile more money in and overcome their natural instinct to, take some of those gains off the table.
And that reason needs to be a big one.
A huge one. It requires either undeniable policy relief from the Fed or just a profound shift in the expected future earnings from those AI giants. And the flatness we're seeing right now, it just signals that neither of those catalysts has arrived yet.
Let's get into the indices themselves. The S&P 500, the SPX, it closed near 6,850 with a year-to-date performance over 13.5%. I mean, that is just a phenomenal run.
It is.
That sustained bullish pressure has to be what's keeping the market from breaking down, even with all these structural risks bubbling up.
It speaks to deep pockets of sustained institutional optimism for sure.
Yeah.
Then you look at the Dow Jones, closing near 48,000. It added about 0.5% last week.
Okay.
And the report describes the Dow's action as choppy, but generally value tilted.
Ah, so what does that tell us? Value tilted.
It tells us a rotation is already happening under the surface. It's favoring those large cap industrials, consumer staples, financials, the old economy names.
Right.
And they're perceived as offering better value or maybe more resilience compared to the high-flying tech sector.
But the real weakness, the cracks in the foundation, they really show up when we look at the Nasdaq composite.
They do.
Because while technology as a sector leads the year-to-date gains with just a staggering 23.67%, November saw a pretty marked reversal.
And that's the critical nuance that you have to grasp here. The Nasdaq itself was down nearly 2% in November, but the core technology sector within it, that declined almost 5%. 4.81% to be exact.
Wow. So that wasn't just some light profit taking.
No. This was aggressive, targeted selling, specifically in the sector that holds the market's highest valuations. It suggests that even the most optimistic investors are starting to question the immediate runway for these hypergrowth names. It's a signal of a potential shift in the market's internal leadership.
So if the Nasdaq is already starting to roll over even just a little while the S&P 500 is still being propped up by the just sheer weight of those mega caps, how is the market interpreting its own risk right now? Let's turn to the VIX, the fear gauge. It's sitting at 15.41.
That 15.41 reading is, it's moderate. It's comfortably below the 20 threshold that usually signals real investor fear.
Right. 20 is the magic number.
It is.
Yeah.
So the KING-KAMBUF analysis interprets this as market complacency contained. It implies that investors are factoring in normal fluctuations, maybe, 1 or 2% moves in the S&P.
Okay.
But they are not pricing in systemic disaster or any kind of extreme volatility.
Contained complacency. That almost sounds like a contradiction, doesn't it? It feels like we're in an inherently risky spot, but the options market is just saying, nothing to see here.
It does.
What's the immediate danger of that kind of moderate VIX reading?
The danger is in insufficient hedging. It's as simple as that.
Yeah.
If traders aren't paying a premium for protective puts, it means market makers haven't adequately cushioned the system for a shock.
Ah.
So if any surprise materializes, let's say the Fed comes out with some hawkish commentary or a huge earnings report like Oracle really disappoints on guidance, the lack of hedging triggers an outsized response.
So it's a bigger drop than it should have been.
Much bigger. We call it an air pocket move, where the market just drops suddenly and violently because that structural support from the options market just isn't there.
It's a classic low tide moment. When the tide goes out, you finally see all the rocks.
That is a perfect way to visualize it. And this is where the report gives a really fascinating contextual layer. Even though the VIX is at 15.41 today, it is up 13.81% year over year.
Okay, so explain that. Why is the fact that the VIX is higher than a year ago significant, even if the current number looks so calm?
It signifies a fundamentally higher level of background anxiety. So while options traders might be calm about the day-to-day moves...
So little wiggles.
Exactly. The cost of insuring against a major long-tail downside event, like a big geopolitical shock or catastrophic credit event, that cost is structurally higher than it was 12 months ago. So institutional money is recognizing that the risk environment itself is elevated, regardless of the recent index performance. They're paying more for long-term portfolio disaster protection, which tells you we are operating on fundamentally riskier ground than we were last December.
So the message is clear. The index gains are masking the underlying volatility. November showed real weakness in tech, and the VIX, it looks calm, but it's really sitting on a coiled spring of higher systemic anxiety. That's a pretty comprehensive setup for the current environment.
I think so. And since we established that background anxiety is higher and the immediate volatility is contained, we need to shift our focus. We need to go from the headline indices to what the underlying capital is actually doing.
And this is where the weak breadth comes into the picture.
Exactly.
The report is It's pretty blunt about this. It says market breadth remains weak. So that means the number of stocks actually participating in this rally is very narrow.
Very narrow.
And the internals show that a lot of stocks are just stuck in these tight trading ranges, while the major indices hold up near their highs. How big of a risk is this reliance on just a few names?
I mean, it's the primary technical risk right after valuation. The S&P 500 is overwhelmingly mega-cap led. We're talking about information technology, communication services, and a couple of those high-end consumer discretionary names. Basically the big 6 or 7 tech titans.
The usual suspects.
Usual suspects. When 34% of the entire index's movement is determined by those few companies, any small rotation out of them has an oversized impact on the entire market. If those giants stumble, the sheer weight of the other 66% of stocks stuck in trading ranges, they can't possibly pick up the slack.
That concentration risk is exactly why a framework like KING-KAMBUF, which we'll get into later, focuses so narrowly on just the most liquid names. You have to be where the action is, or you just risk being left behind in a low-volume sideways grind.
Precisely. Now, let's talk about the big headlines that actually managed to cut through this narrow market focus. The reported $83 billion acquisition of Warner Bros. Discovery by Netflix. I mean, that was a shockwave in the media world.
An $83 billion M&A rumor. That is massive. It immediately signals a fundamental shift in the whole streaming landscape. It suggests a scramble for consolidation as that market starts to mature.
And it drove significant volume. WBD surged over 6%, 6.28% to be exact. That made it a high-conviction buy watch for the week ahead in the KMBUF analysis. They're targeting a move up toward $28.
Okay.
This is a classic example of fundamental news providing a clear, immediate catalyst for alpha that just overrides the general market fatigue.
And it also suggests something about the regulatory environment, doesn't it?
It does. It implies that investors believe the environment is still open enough for these mega deals to actually go through, which is an important psychological marker for the market as a whole.
Okay, so let's move away from equities for just a second. We saw a really sharp divergence in the highly speculative crypto space, which kind of reinforces that cautious tone we were talking about earlier.
Yeah, while equities were getting these modest gains, Bitcoin tumbled over 7%. It fell below $85,000. This is a flight from high beta, high risk assets.
So speculative capital is getting nervous.
It's getting nervous and it's differentiating. It's drawing a line between the relatively stable growth narrative of the mega cap tech stocks and the more volatile pure risk assets like cryptocurrency. When investors get nervous about systemic risk, even if it's just the risk of high valuations, they pull money out of the most exposed areas first. Crypto is always one of the first to go.
And this is where it gets really interesting for me. Let's look at the 52-week extremes, because they show us exactly where capital is fleeing to and where it's consolidating for safety.
Right. On the high side, you see strength in defensives and industrials. Walmart and Caterpillar, both of them hitting or getting near their all-time highs. This just confirms that rotation into value and resilience we were talking about.
Walmart shows the consumer is stable, and Caterpillar is a play on infrastructure and global trade.
Exactly. Investors are seeking quality, tangible earnings that exist outside of the high-flying AI narrative.
At the same time, though, we also saw Salesforce CRM surge over 5% on its Agentforce AI strategy. So that reinforces the idea that the market is willing to pay, and pay handsomely, for a credible, monetizable AI story. But that story has to be crystal clear.
Absolutely. The market is distinguishing between just having AI exposure and having clear AI monetization. CRM surge wasn't a general sector bounce. It was a specific reward for communicating a growth roadmap that's tied directly to AI applications to their enterprise customers.
And what about Goldman Sachs hitting a 52-week high?
That's a sign of a less aggressive fear around rate cuts. Traditional investment banking benefits from more normalized capital market activity. So a strong Goldman suggests the market isn't only betting on a panic-induced rate cut.
Okay, but then we look at the other side of the coin, the 52-week lows. And you see distress concentrated in these rate-sensitive sectors. Bank of America, Wells Fargo are near lows. So is VCI Properties, which is a high-debt REIT.
Right.
I want to spend a moment on the financials because this feels a little counterintuitive when the Dow is strong.
This is a crucial technical point, and it's all about something called net interest margin, or NIM.
NIM.
When the market price is in such a high probability that 87% chance of a Federal Reserve rate cut, it immediately affects bank profitability.
How does the expectation of a cut harm bank profits today? It hasn't even happened yet.
Because banks make money on the spread, the difference between the interest they earn on loans, their assets, and the interest they pay out on deposits, their liabilities. That spread is the net interest margin.
Got it.
When the yield curve flattens, which is what happens as the market anticipates cuts and those short-term rates drop, the rate banks earn on their assets often drops faster than the rate they pay out on deposits. This compresses their profit margins.
Ah, so the spread gets smaller.
It gets squeezed. The fact that Bank of America and Wells Fargo are near their lows suggests the market is deeply pessimistic about their NIM in the coming quarters, even if the overall economy is resilient.
And the REIT, VCI.
That's a different but related reason. High debt, asset-heavy businesses suffer when interest rates are high. Their borrowing costs soar, and refinancing becomes punitive. So they're getting hit by the current high rates, while the banks are getting hit by the expectation of future low rates.
So the weakness in these financials is a direct technical result of the market so heavily pricing in that Fed cut.
Precisely. It's a technical side effect of that anticipated policy shift.
Let's just quickly touch on the speculative extremes, the low-volume names like Treasure Global, SMX, Reeds Inc. The report highlighted some massive swings, like a 245% gain and a 51% drop.
Yeah, we have to acknowledge them, but we shouldn't dwell on them. They're pretty much irrelevant to the broad market structure.
They're just a sign of the fever.
Exactly. They serve as a marker of high-risk speculative fervor. These are usually low-float, low-volume stocks that are prone to these massive swings on just minor news or pure retail momentum. They tell us that risk appetite is present, but it's concentrated in what you might call the lottery ticket end of the spectrum.
Right.
The main takeaway for the serious investor is that the punishment for failure like SoFi Technologies dropping on a big public offering due to dilution fears, or those small-cap biotechs falling on bad trial news, the punishment is swift and brutal.
Okay, so that sets the stage perfectly for part 3. Earnings intelligence, what's driving growth, and more importantly, what's coming next.
Right. We've established all the structural risks, the valuation, the concentration, the NIM compression, and this high degree of expectation that's priced into the market. Now we have to pivot to the engine that is supposed to justify all these prices, corporate earnings.
So let's review Q3 of 2025 first. How strong was that underlying growth foundation?
The foundation was remarkably sound, actually. The Q3 2025 S&P 500 blended growth came in at plus 13%. That was a significant beat of the consensus forecasts.
And that's not marginal growth.
Not at all. This shows broad-based, strong execution across corporate America.
And this leads us directly to the core of the market's entire bullish argument, the forward outlook. This is the only thing that justifies that 40.01 CPE ratio we talked about.
That is the key trade-off right there. The forward 12-month outlook projects an astonishing plus 21% earnings growth for the S&P 500.
21%.
Yeah. Investors are effectively saying, look, we know we're expensive based on historical earnings, but we think we're reasonably priced based on 2026's expected earnings. If that plus 21% forecast holds up, a lot of the current valuation worries, they start to dissipate.
But that growth is highly concentrated, isn't it? It's not coming from everywhere.
Not even close. It's completely concentrated.
Yeah.
The responsibility for delivering that 21% growth is carried primarily by two sectors. Information technology, expected to grow earnings by 26.6%, and consumer discretionary, expected at 26.4%.
So those two sectors alone are the structural pillars holding up the entire market's high valuation.
They are. If either of those sectors misses its target, the entire market outlook becomes incredibly precarious.
Which brings us to the upcoming gauntlet, the week of December 8th to the 12th. This is the moment of audit.
This is truly pivotal. We have Oracle and Adobe reporting on the 10th, then we have Broadcom reporting on the 11th, and alongside them, we get key consumer health checks from Costco and AutoZone.
But the market's going to ignore everything else that week to focus on those three tech giants, isn't it?
Completely. This is the AI valuation test.
So how do we audit this narrative? What are analysts looking for beyond just a simple earnings per share beat? Because that's not enough anymore.
No. It's no longer about simple beats. The market is priced for perfection and for acceleration. For Oracle and Adobe, analysts will be laser-focused on annual recurring revenue growth, ARR, and cloud consumption rates. They need to show that their AI initiatives are directly translating into enterprise customers, expanding their cloud spending, and locking in these long-term high-margin contracts. A strong ARR number validates the entire strategic shift.
And for Broadcom, that's more of a pure infrastructure play.
Broadcom is the semiconductor and infrastructure bellwether. For them, we need to see clear, strong guidance on the outlook for infrastructure spending. specifically the demand for high-speed networking components and AI accelerators.
So if enterprise spending on hardware starts to slow down?
It would be catastrophic for the entire tech complex. It would signal that the massive AI investment cycle is pausing. A miss on their forward guidance would trigger widespread profit-taking across the board.
We've seen just how unforgiving the market is right now. Let's use some recent earnings reports to illustrate this punishing expectation level. DocuSign feels like a perfect cautionary tale.
It is. DocuSign fell about 6%, despite actually beating their earnings expectations.
So they beat, and they still went down. Why?
Because their forward guidance on subscription revenue disappointed. This tells you that past performance is totally irrelevant right now. The market only cares about the rate of future acceleration. If that growth trajectory is anything less than spectacular, the stock gets punished immediately. It just illustrates the fragility of these valuations.
And then conversely, you had Salesforce CRM, which just soared. That was all about the narrative, wasn't it?
It was entirely about narrative conviction meeting solid execution. CRM surge was driven by investors aggressively buying into that Agentforce AI strategy. It validated their belief that core software companies could successfully integrate AI agents and then monetize them immediately, guaranteeing future ARR growth. The market is explicitly rewarding credible AI narratives.
And we should mention Ulta Beauty, ULTA, which is a great example of quality execution outside of the tech mania.
Yeah, Ulta's strong earnings beat led to a huge pop, something like 12.65%. It demonstrates that if you are outside that heavily congested AI space and you can deliver exceptional numbers driven by a resilient consumer, the market will disproportionately reward you.
Why?
Because it's starved for diversification and quality execution. The message for this week is clear. The bar is set incredibly high, and this is the final audit for the entire AI-driven bull run of 2025.
All right. We've established the high bar set by those expected earnings. Now let's confront the cold, hard numbers that tell us precisely what risk we're taking to achieve those expectations. So, what does it all mean when we combine these current price levels with the historical context?
It means the structural concerns are concentrated entirely in valuation. The S&P 500 price-to-earnings ratio is sitting at 27.88. That's already elevated relative to long-term historical norms.
It's high, but not insane.
Not insane. But the number that truly screams caution, the one we mentioned earlier, is the Shiller-Cape ratio.
The cyclically adjusted price-to-earnings ratio. It stands at 40.01. For our listeners, let's take a moment to really understand why this number is so critical and, frankly, so terrifying.
The KPE ratio, which was developed by Robert Shiller, it takes the average earnings over the past 10 years and it adjusts them for inflation. It does this to smooth out the volatility of the business cycle.
Okay, so it gives you a longer-term view.
A much longer-term view. And a normal historical mean for the KPE is around 17.
17. And we're at 40.
We're at 40.01. We are firmly in extreme overvaluation territory. Historically, the only other times the KP has been this high were leading up to the 1929 market crash and the late 1990s tech bubble.
That immediately implies a serious reckoning is on its way. The historical correlation suggests that returns over the next 10 to 20 years will be abysmal, or that a very sharp correction is imminent. So why is this time different, or is it?
That is the central question the report forces us to ask. The traditional argument for why this time is different rests on really two primary pillars. First, globalization and lower real interest rates.
Okay.
Globalized earnings mean that today's S&P 500 companies have much broader, more stable revenue streams than the companies of 1929 or even 1999.
And the second pillar?
The second is the structural shift to asset-light, high-margin, technology-driven business models. The mega caps today have much higher returns on invested capital, and they require less physical infrastructure than the industrial giants of the past.
So the argument is that maybe the historical average KPE of 17 is it's irrelevant in a structurally altered, low-interest rate, high-tech world.
That is the bull case counter-argument, yes. However, the report's analysts remain very cautious. They state that regardless of the structural changes, a valuation this high creates incredible technical vulnerability.
And that's where the 10% decline projection comes from.
Exactly. This is why analysts project a potential 10% decline over the next 3 months. It's not a forecast based on economic failure. It's a quantified risk based on the historical behavior of markets at these kinds of valuation extremes.
And this vulnerability, it must be massively compounded by the index concentration that we touched on earlier.
Undeniably, the concentration risk is just. It's immense. Information technology commands 34.0% of the S&P 500 index weight. The index is essentially an ETF of NVIDIA, Apple, Microsoft, and Amazon.
It's a systemic risk in itself.
It is. If just one of those four components were to experience a specific regulatory issue or an earnings disappointment, the entire index gets pulled down disproportionately. And the vast majority of managed funds, they have to hold these names just to match the index. That leads to crowded trades and a much higher risk of systemic failure if momentum ever reverses.
Looking at the year-to-date sector leaders, there's something fascinating there. The fact that utilities at plus 22.23% is the second strongest YTD leader, right behind tech at plus 23.67%. That's a wild juxtaposition.
It's the clearest sign of an internal contradiction in the market. Utilities are classic defensive, low volatility, dividend-paying stocks.
The safe stocks.
Safest of the safe. For utilities to be performing almost identically to technology year to date, it indicates that throughout 2025, sophisticated capital has been aggressively seeking two things at the same time: hypergrowth from AI and absolute safety and yield from defensives.
So it's a portfolio structure that's basically screaming, I'm bullish on tech, but I'm terrified of everything else.
That is a perfect summary of the market's internal mindset right now.
And the report highlights a crucial shift in November that supports this idea of de-risking the style and cap rotation.
This is a key internal indicator. It suggests that institutional money is finally starting to diversify away from the largest, most owned names. Growth stocks, which were up over 18% year-to-date, actually declined 1.68% in November.
While value stocks.
In sharp contrast, value stocks surged 2.66% during that same period.
That is active rotation. That's not just noise. Investors were booking gains in their momentum names and deliberately moving that capital into cheaper, less volatile value stocks.
Exactly. And the data shows the flight from the largest names specifically. The Russell Top 50, which represents the market's giants, was down over 10% in November.
Wow, 10%.
At the same time, broader market participation is showing signs of life. Small caps, the Russell 2000, are up 13.45% year-to-date. That indicates money is finally starting to flow down the capitalization spectrum.
Which is classic late-cycle behavior.
Classic. Searching for overlooked value after the high flyers have become prohibitively expensive.
So despite all these flashing structural warning signs, KPP at 40, severe concentration, internal rotation, the market hasn't collapsed. Why is the underlying economic foundation so resilient that it can support these prices?
Because the foundation remains remarkably robust. And it's all centered around the consumer and controlled inflation. Business inflation expectations are at their lowest level since early 2025.
And things like rent are softening.
Exactly. Crucial elements like rent pressures are softening. This provides the necessary cover for the Fed to consider those anticipated rate cuts.
And the consumer just continues to spend aggressively.
Remarkably so. Retail sales grew 4.1% year over year, and that's excluding autos. Online sales were incredibly robust, growing over 10%. Walmart's strong 4.5% same-store sales growth, that demonstrated that this is broad-based retail resilience. It's not just high-end spending.
And it all comes back to the labor market.
It always does.
Yeah.
The American consumer, supported by a continued strong labor market, remains the bedrock of this equity market. As long as people are working and confidence remains high, the market can tolerate these high valuations because that massive projected earnings growth of 21%, it remains viable.
Okay, that makes sense. So we've translated the structural analysis. Now we move into the decisive action. Part 5, the week ahead, critical catalysts, and the playbook.
Right.
What are the key decision points and the playbook for these upcoming critical weeks?
There is one absolute, unquestionable critical catalyst. The Federal Reserve rate decision, scheduled for December 17th and 18th. Everything else is subordinate to that date.
And the market consensus is heavily tilted towards a cut, isn't it?
It's highly tilted. The market is pricing in an 87% chance of an additional 0.25% rate cut. And that high expectation, it creates a very binary situation. The market has already baked in a dovish Fed.
So what happens if that 87% scenario actually materializes?
If the cut is delivered, and if the commentary remains appropriately dovish, suggesting a path for further cuts in 2026, it provides the liquidity boost that's necessary for the Santa Claus rally.
Okay.
It would validate the risk-on positioning, especially in those rate-sensitive sectors that have been lagging. It would likely ignite the bull case.
But what about that 13% chance? What if the Fed holds rates, or even worse, uses hawkish commentary?
That would be the trigger for the bear case. If the Fed disappoints, it pulls the rug out from under the entire interest rate environment that has supported risk assets all year. It would immediately exacerbate that structural overvaluation risk, and it would likely trigger the aggressive profit-taking that analysts are warning about.
Driving the S&P 500 towards that 10% decline target.
That's the risk.
So let's review the three market outlook scenarios that the KMBUF Reserve Report provides for the end of 2025 based on these catalysts.
Okay. The base case assumes the Fed acts as expected, but the AI earnings reports are merely adequate. Not spectacular.
That's okay.
Just okay. This leads to market consolidation near the current elevated levels, with movement limited to a narrow 0 to 2% range through the end of the year. No collapse, but no surge either.
The bull case, that one relies on both liquidity and performance.
Correct. The bull case requires a perfect synergy. You need the Fed cut plus blockbuster reports from Oracle, Adobe, and Broadcom. This combination would spark a powerful, liquidity-driven rally to new all-time highs, fulfilling that Santa Claus promise. The report targets an additional 5% gain by December 31st.
And the high-risk bear case is what gets us to that 6,200 S&P target.
That is the projected 10% correction. It happens if the AI bubble concerns prove correct, meaning the forward guidance from the earnings reports is weak, or if the Fed delivers a surprise hawkish stance. Then the technical indicators, which are already warning of overextension, would drive a sharp corrective phase.
Given these scenarios, let's translate this into some real investment guidance for our listeners.
Okay, so we're connecting that cautious optimism with selective opportunity. For conservative investors, the advice is all about capital preservation.
Right.
Increase defensives like healthcare and utilities. Maintain a large cash position, 20-25%, and drastically reduce that highly concentrated tech exposure to below 15%. They're basically positioning for the bear case downside protection.
And for moderate investors, they need to be much more strategic in their rotation.
Exactly. They should be moving toward a balanced 50-50 portfolio. That means reducing their reliance on the mega-cap tech holdings that have driven all the performance in 2025, strategically adding value stocks, but also maintaining liquidity to monitor any AI corrections for potential entry points. The goal is to avoid the major systemic downside while still participating selectively.
And for the aggressive investors who want to maintain their growth exposure, the mantra here must be risk management.
Absolutely. Risk management is paramount. They must use tight stop losses. They have to recognize that the volatility is high even if the VIX number looks low. The guidance is to use the potential 10% decline as an opportunity, adding oversold AI names, but only on confirmed 10% pullbacks from their recent highs.
And they have to be more active.
Much more active. They have to increase their rotation frequency, capturing momentum while respecting their stop losses religiously.
This sounds like the perfect environment for that T-KIF trading framework, which the report really emphasizes for the more active listeners. Let's delve into the mechanics of why that specific strategy is suitable right now.
Well, the T-KIF strategy is really tailor-made for this kind of mixed-breadth, high-concentration environment. Since the broad market is struggling, but a handful of liquid names are steering the entire index, the strategy focuses ruthlessly on a curated, liquid basket of just those mega caps.
So why the intense focus on liquidity?
Liquidity allows for tighter risk management. It's that simple. If a stock is highly liquid like Apple or Nvidia, you can execute a stop loss precisely and immediately, minimizing any slippage.
Okay.
This enables the core risk management rule of the framework, a very tight, disciplined approach using an entry price plus or minus a 1% stop loss and a plus 1.5% profit target. You're aiming for these high-probability, quick-range trades, knowing that a 1% move against you means your initial thesis has already failed.
And there's a specific timing element to this, too. It's designed to avoid the high-risk periods of the trading week.
Operational discipline is everything here. The strategy emphasizes entering trades on Monday evening or Tuesday morning and then exiting by Wednesday afternoon.
So you're out before the end of the week.
You're out. This avoids that late-week event risk major economic data, Fed speeches, or geopolitical news that frequently hits on a Thursday or Friday. That kind of news could instantly negate your tight risk management parameters.
Let's review the three conceptual trade templates that use that T-KIF logic for the active listener.
Okay. Slot 1 is the mega cap tech leader. This is your core index anchor, think Apple or Microsoft. The setup requires the stock to be trading safely above its 20-day moving average. You're buying a slight pullback, but within a confirmed uptrend.
And slot 2, that targets the sheer momentum that's driving the market, AI semi-momentum.
These are your high beta plays, Nvidia, AMD, Broadcom. The entry criteria here are quantitative and very strict. The stock must demonstrate strong 5-day relative strength versus the S&P 500.
So you're buying strength.
You are buying strength. But that 1% stop loss prevents you from chasing and controls the volatility risk. You're just looking for that quick plus 1.5% surge before you lock in your profits and get out.
And slot 3 is the value counter trend play, which acknowledges that recent rotation we talked about into defensives.
Right. The defensive value counter trend targets names like Lockheed Martin, Walmart, or Costco. The setup here requires recent underperformance. The stock has been oversold, but then it confirms a higher low versus its prior swing low.
So you're buying a dip, but a structured one.
A very structured one. You are buying low in its established range, anticipating a modest reversion back toward the mean. You're participating in the value rotation without taking on excessive directional risk. The success of this entire strategy, all 3 slots, it hinges entirely on ironclad discipline.
We have covered an enormous amount of ground in this deep dive into the KAMBUF reserve report. I mean, the market is defined by this crucial dichotomy right now. You have the terrifying structural risk of the Shiller KP ratio at 40.01 on one side.
And on the other, you have the powerful, expected fundamental strength of a plus 21% forward earnings outlook.
And the market story is really being written by that handful of mega caps that are reporting this week. Their results will either validate this massive rally or they'll trigger the systemic profit taking that's needed to deflate these high valuations.
Everyone's focus is split. It's between those AI earnings reports and the looming Federal Reserve rate decision, which, again, is priced with an 87% chance of a cut.
So the primary risks to remember as you look ahead are that AI bubble concern and the quantifiable technical risk of a 10% decline over the next 3 months, driven by overvaluation. In this environment, discipline and tight risk management, especially using highly specific frameworks like TKIF, they're absolutely paramount.
You know, this all raises a really important question for you, the listener, to mull over as you navigate these conflicting signals. We detailed a resilient economy, strong consumer spending, that 4.1% retail growth, and moderating inflation expectations.
Right. The foundation is strong.
The foundation is strong. So if the underlying economy is fundamentally strong and the technology driving these mega caps, the AI, the cloud infrastructure, if that represents a sustained structural leap in corporate efficiency and productivity, a genuine paradigm shift, then how much of that overvaluation shown by historical ratios like the CP at 40.01 is simply the market adjusting to a fundamentally higher, more efficient ceiling for corporate profitability? Is this truly a bubble that's set to burst, or are we witnessing the historical validation of structural change driven by the very AI companies that are causing the bubble fears? That's something for you to explore on your own as you review your portfolio expectations.
A truly profound perspective. It forces us to reconcile history with modern reality. Thank you for joining us for this deep dive into the latest analysis from the KAMBUF Reserve. We hope this report gives you the edge you need for the week ahead.
Trade smart, manage that risk tightly, and we'll catch you next time.